Welcome back to the Hurdle Rate. I'm Tim Kotzman. I'm here with Matt Cole, Ben Werkman, and Jeff Walton. This is episode 34 for the week of November 3rd, 2025. We're going to talk briefly about SEDA from Strive, the launch and announcement of that preferred offering this morning, and also Stream, the European equivalent of Strife from Strategy, out just not even an hour ago. So I guess, Matt, over to you.
Yeah, there's not a whole lot we can say about SEDA other than we announced the IPO of it today, and that's going to go quickly. And then once it's out in the market and trading, we can go in depth. So we'll go in depth on all things SEDA as a security, what it means for Strive and ASST on the common. But that's next week's topic. For now, check out the presentation. It's on X. It's on our website. It's Ben, Jeff, and myself going through what we can say now, and a lot more to say starting next week, and can't wait for that. But we have Stream and we have Strategies earnings, so a lot to talk about anyways today.
Absolutely. Jeff, you want to kick us off on any thoughts you have from the earnings call? And also, I know Stream just came out literally before we started streaming, but this is just one thing after another.
Yeah, everybody's moving fast here in the industry, and just coming off of the back of the Q3 strategy earnings call, I thought it was another phenomenal masterclass walking through the advancement and development of managing a Bitcoin-backed balance sheet, shifting focus into preferred equity, expanding into international jurisdictions, offering these products in new places, and here we go. As of today, now we have Stream, which looks like a fixed 10% dividend rate offered in Europe. So effectively like STRF in the European markets. Maybe I'll kick it over to Ben and Matt. We've been grinding over here, so this is hot off the press on our brains here.
Yeah, I think it was interesting, not totally unexpected. I mean, after the earnings, they pushed pretty hard, and they specifically highlighted running these products in Canadian dollars as well as in euro denominated. And so here we see the first one that's up with Stream. I also think just in general in the Bitcoin space, it's just been massive news. Everything from the Bitcoin mining sector, now they're all landing these massive AI deals, basically these HPC deals. You saw Iron land one, you saw Cypher land one. So there's a ton of activity going on in that space. And then obviously in the Treasury company space, there's a ton going on. What so far I find interesting around Stream is that it's kind of in the middle of their equity stack. And so while Strife, which is the product that's the most similar to Stream, sits as the senior most in the capital structure over there, Stream actually falls below Strife and below Stretch. So it's going to be the third one in the capital structure, which will mean that Strike and Stride are going to be the two that are junior to it. But outside of that, going through, it seems fairly straightforward now that we've all had the time to really digest Strife. You've got a 10% fixed dividend per annum. You've got cumulative dividends. I don't see a ton here that really jumps out at me as odd, which I think is probably incredibly intentional here. When you spend the time marketing a certain set of products and you build products that are meant to cover a wider range of use cases out in the market, sometimes when you go into a new market, the best thing you're going to be able to do is bring something that's familiar, that already has some certainty around it, that already has a track record of success in another market. And that means that you're going to be able to go to those investors and tell a very clean and clear story as to what this product does for them. So seeing them take, Strife, which now has, one of the longer track records of their prefs, with the exception of Strike, I think was a smart move. And I think not giving it too many moving parts as you enter into that market is also a very smart move because it's very easy to understand. You're going to get 10% at the stated amount, period. And that is it. But what I do think it does is it leaves them availability to launch more products in the market. And I think what you're going to start seeing is a replication of the model that they're building out in the US. Now, we'll see if that means all if they try to build out that yield curve in every market, or if they're going to find that they've got one or two products that really meet a mass need where they can bring in significant sums of capital and really up that amplification on their balance sheet. And maybe in some of these other markets that are a little smaller, we might see one or maybe two of these products that are kind of universally applicable within those markets. So I think it's a really good move. I think that familiarity and a very simple story of saying, would you like 10% interest rates is pretty compelling. And I think that brings in a lot of capital right away.
One of the things that stuck out to me on this was it was kind of an unknown in my mind if they were just they found so much success with stretch. Were they just going to go the European stretch, the Canadian stretch, the Japanese stretch, the Nigerian stretch, just like, everywhere around the globe. And what I think you're seeing here, to your point, Ben, is actually more of a chess move of we are going to go into each market one step at a time and build the whole digital credit yield curve in these different larger markets. And if you look at just back at when Strategy started this in the United States, the first deal, what did it price at? 80 cents on the dollar, then it was 85 cents, then 90 cents. And so the first time kind of going to the market's probably the roughest time because you're telling your story, you're kind of proving yourself. And as much as Strategy has proved itself in the United States, my guess is that many European accounts, they have to start those conversations with, yes, they're probably familiar, but like, nice to meet you, Michael Saylor, and earning that trust and as a new issuer in Europe. And so they start with something that, is not the thing that was the iPhone moment for them, but something that was successful. A successful launch. They continue to, ATM all these instruments in the US. And I think that makes sense from the long game perspective. And clearly they have a desire and a need to issue billions and billions of dollars of digital credit. And so why start with at the end versus inch your way in and kind of build that market over time? I think that makes a lot of sense.
Makes you wonder if they're going to have every single one of their instruments in every market, right? And maybe that's possible. And one thing that's interesting, I'm just kind of working through the presentation here, but there's a European hybrid market comparison slide, and maybe I'll share my screen. And it's showing the relativity of these instruments, the Strategy Stream instrument from a pro forma credit rating perspective at B minus by S&P 500, which was probably what we think they will be rated in the future, compared to other European market instruments that are also B rated. So just looking down here at the bottom, Stream effective yield of 10%, and then you go look at every other B rated instrument, and it's got a 400-point credit spread on all of the B rated instruments. And on a tax equivalent basis, it's a 1,000-point credit spread over and above all of these other European credit instruments. So, thinking about the risk profile and the alpha generated from these instruments just by understanding the future and potential credit quality, if anybody gives them any capital credit for the Bitcoin held on balance sheet, these things look incredibly attractive from a risk perspective.
So now comes the big question. So it looks like they're going out with a 350 million euro initial offering size. What kind of demand do you guys think they're going to see for this? We've seen some pretty significant upsizings in their original IPOs. Are you expecting to see the same thing here? Or do you think going into a new market is going to be a little more muted than what we've been seeing in the American markets?
I have no idea what the demand for Europe
I was going to say the same thing. I have no idea. I mean, I would think that there's a lot of demand. They probably could have gone bigger if they would have started with the stretch equivalent. And so, but I would be surprised to not see an upsize. But obviously, these things come down to ultimately pricing, the type of accounts that they're looking to build. So I did see that I think this is institutional only. It looks like retail cannot participate in this, which, probably potentially caps the upside of the upsize, but maybe I'm wrong. And that we will have to find out.
I think just for some context, that some of these B-rated deals are significantly larger than the initial launch here. So I would suspect if anybody has liquidity in any of these instruments and you're holding these and you have an opportunity to look at some of these, that there could be some opportunity there. I wouldn't be surprised if it doubles, though.
I was going to say, I'll go out on a limb and say it'll double or triple.
Doubles. Yeah, I wouldn't be surprised if it doubles.
I mean, you got to look at it in terms of what they've got in the pipeline for new issuances coming out. Obviously, they've got their intentions for the Canadian product to be out there, but these initial IPOs have been one of the primary ways that they're able to increase the amplification on the balance sheet, is this initial injection of capital, and then it takes some time before they can really scale some of those. So I won't be surprised to see them willing to get a little aggressive to get this deal done at a significant size here. So yeah, I think what Tim said, double to triple is probably what the target is. But again, anytime you're entering a new market, that market's going to have its own nuance, and those investors are going to have their own way of evaluating the credit that they're looking at here. So it's going to be fascinating to see. This is the next step in the expansion of digital credit, is it's moving out of the U.S. markets and it's hitting the global markets.
A tiny dagger, though, to STRK and STRD, right? You now had multiple instruments that are getting issued senior to those, so impacting liquidity, credit quality, and uncertainty. There's just an uncertainty element with those instruments as well. So it will be interesting to see how pricing of those instruments changes over time, issuing something senior in the capital stack to that particular instrument. I mean, from our perspective, the credit quality probably changes from a couple basis points being Bitcoin bulls here and thinking about downside, but it still exists. That change in risk profile still exists.
Yeah, looking at the products, I wouldn't be surprised to just see a Strife and a Stretch equivalent in each of the markets, right? Obviously, with Strike, you got the convertibility feature to the equity. So I think you'd probably have to have the equity trading in that market before you'd be able to do that, maybe. And Stride, I'm not sure whether that would be one of their primary fundraising mechanics where they'd have the demand.
Yeah.
And so I think that one's still well suited in the US markets, but I'm not quite sure that it plays quite as strongly in the global markets. I might be wrong there. But I think that Strife and Stretch ultimately, I think you're going to see those two being replicated across the different markets that they decide to enter.
Fascinating stuff. The future is here. Digital credit is here. One thing I was thinking about that, and I continue to think through this and hit on this, is what is separating just Bitcoin treasury companies away from DATs, that are holding these other cryptocurrencies. DATs that are holding other cryptocurrencies are one-trick ponies. You sell equity and you buy the underlying cryptocurrency. With the development of digital credit, you are now leveraging a large balance sheet of capital, and you're using it as collateral to create risk tranches that you're selling to different marketplaces. You can underwrite that. You can underwrite the risk of Bitcoin. It becomes significantly more difficult to underwrite the risk of any of these other cryptocurrencies with a centralized authority. And I think that narrative will allow for a big separation between all of these other cryptocurrencies and Bitcoin, which will probably, in my mind, dominate the credit market for crypto-backed credit, because there will need to be a credit spread between any Bitcoin-denominated debt and any other alternative crypto-denominated debt, and that credit spread will likely be very wide.
I think the other problem with some of the other debts is you're effectively trying to underwrite the credit on a technology. And I think that's a little different than when you're trying to underwrite the credit around Bitcoin, which is a very clear commodity with a very clear use case. If I'm looking at any of these other tokens and they were to start trying to issue their own version of these credit instruments, I'd have a very difficult time underwriting that, because you're fundamentally in a position where you can be disrupted very quickly. Right? If you're trying to tokenize certain things, or the economics of the fee structure really become material, and you've got new chains coming out, launching tokens that have similar capabilities but significantly lower fees, you're kind of in this position where the future is unknown. Whereas what Bitcoin's trying to do is just say, hey, unless you think that they're going to stop printing money and they're going to have to stop stimulating. I'm the solution to that problem. And because that is a structural problem that's built in, that's something that you can count on. You've got the fixed supply, you've got no central issuer, there's no foundation that's managing it. You're a very different value proposition and a simple one. And I think that matters. I think to the extent you're going to do things like this, where you go issue digital credit, you need to be able to tell a simple story around the asset that you're using to back it. And I don't think that same story exists for any of the other assets.
Bingo. Shall we shift gears, talk Q3 earnings call?
Yeah, there was a lot there. Maybe we should start with our man that was actually on the call. Asked the question that got the classic sailor response.
It did, yeah. It was kind of funny. When you get set up, they send out the schedule ahead of times, and you got to give them a lot of credit because they don't ask you for questions ahead of time, right? It's completely unscripted, and they specifically ask for difficult questions, no softballs is in the email. So they give you no guidelines, they don't have to review anything, and then they ask you to ask hard questions and don't give them anything that's a softball. And I thought, going last, you don't know what's going to be left because I had a list of probably 20 questions that I'd written out ahead of time because, you just have to cross them off as people ahead of you ask those questions. And so we got to the end, and I thought one of the things that was important was, to highlight that the common equities struggled during a year where the balance sheet expanded significantly, and now they've struggled to put on the amplification that they desire. And I wanted to hear how they viewed that. Now, with a guy like Saylor, you never have any doubt that he's prepared for that question, right? I mean, you can't come into earnings, you know how your equities have performed, you know what the noise has been on the internet, but it was one of the common questions that people really wanted to answer. And I thought that he gave a really insightful answer. And it kind of showed a different side of their strategy that really highlighted the broader mission that's at play there. When he starts talking about bringing a sound retirement to 1.8 billion people, that's a different type of mission than, go raise capital, raise Bitcoin per share. That's one where you've got to focus on bringing an improvement to the world with this new product that you've created effectively. And I thought that that was a really cool perspective to hear from him. Now, it didn't take away from his desire to win, because clearly when he made the statement that he wants MSTR to stand for monster and they want to eat the world, there's still fire there, which you always wonder when you achieve this much success and your company's scaled this large and now your people are making comparisons from your treasury to Berkshire's treasury. Like, do you just say enough, we've won, right? And the clear answer that he put out there was absolutely not. Like, we've hardly scratched the surface here. We think this is a massive idea. We think that this is fundamentally going to change the way people look at finance, the way they look at savings, the way they look at investing. And we want to be one of the main players there. And for people like us, we love to hear that ambition as well. Because when they opened up this idea of digital credit, it took some time to get that education out there. And I know we've all seen the possibilities that are here, but being a part of this broader effort to really drive that change out there and to help to educate the masses on what this means and the way that this can benefit them and how they can take the power of Bitcoin and the way it was very methodically designed and build that into their own financial lives through whether you want the long exposure on high octane or whether you just want someone to take all the risk and volatility out of it and you want a sure thing. You get to participate in that. And that's a huge movement, and we're so early because there's so few issuers now. So hearing that to close out the call, I don't think that probably could have gone any better from their perspective, when he just went on a heater there for 5-10 minutes and really laid out a vision. So it was great to see.
I got the iPhone moment. You got the monster moment.
Yeah, geez.
See what Mac gets next time.
We'll see. Maybe it's Kotzman. We'll see who gets the call. But I think a couple things that really stood out to me on that part. One, I think the willingness to just be patient, and we talked about that a little bit with regards to stream and not starting out with the stretch equivalent in the European markets, but probably playing the long term there. And when he talked about we can just idle and earn 30%. And I think that that is something that a lot of people struggle with. And I feel like it, for us, I feel like it's actually one of the reasons we even started the hurdle rate, because we have a longer term perspective, and we have even though the haters like to make fun of it, the zoom out mentality, that just is embedded in us, the willingness to be patient and then move really fast. But I think a lot of people struggle with that, and that's how you get yourself into trouble, taking bad terms that can be, take forever. You may never be able to get out of. He's cool to wait, but he's also cool to move extremely quickly when a door is open. And I thought that was, one part that, that really stood out to me. And the other part is something that should be very intuitive when you actually unpack it, but I think is not intuitive to the space, and it's the time horizon of investments for Bitcoin treasury companies. And so he mentioned a 10-year time horizon. And I think it's literally this simple. The more volatility that's in an asset, the longer the time horizon needs to be. And so when you take stretch, that's when he talks about the checking account. He wants to talk to the grandpa and say, you could put your checking account into stretch. Has basically no volatility, and he could feel comfortable saying that. And then you talk about Bitcoin being something that we talk about frequently, being at least a 4-year time horizon. Now, obviously, my view is it's going to go up forever. They're never going to stop printing money. But like with the volatility, if your time horizon's under 4 years, it's actually a risky bet. And then with volatility on volatility in a Bitcoin treasury company, you need a longer time horizon. And so while it's true, and he stated this, is like on an average 4-year period, like our goal is to outperform Bitcoin. I'd be surprised if we didn't. You probably need a 10-year time horizon to comfortably say more volatility than Bitcoin is likely to work in your favor in almost all scenarios. You take the Monte Carlo simulation of approach of tens of thousands or a million scenarios, and what is the chance that it's down after any given 2, 3, or 4-year time horizon? It's not zero, but the more you can zoom out, the more you can ride out that volatility comfortably in it. And it was refreshing to hear him say that to the masses. And I think, frankly, just completely rejecting the short-termerism that I'm sure he feels and others feel is no, I'm going to stay focused, and we're going to stay focused on taking good terms, building out this methodically for the long run. And if you want to be a part of it, we have name your security that should fit your investment time horizon.
It's just math, really. Like that volatility calculus, like I think back to my finance days, this is efficient frontier mathematics, like developing a portfolio that's got multiple securities with different risk return metrics, and those return metrics being volatility, improving your position on the efficient frontier. So yeah, it's all mathematics, and all of these instruments create that curve of risk return profiles within the Bitcoin ecosystem, which we've been talking about for quite a while, which I think is just the fascinating innovation here. And it's been interesting to see the market dynamics on X, talking, a lot of Bitcoin bulls. Why would I ever buy stretch? I'm so bullish Bitcoin right now. Well, what happens when you may not be bullish on Bitcoin anymore? Like, do you rotate out? Like, if you're a trader and you're bullish on Bitcoin in the short term, what happens when you're no longer bullish on Bitcoin in the short term? What do? Do you want to hold dollars? Well, your whole thesis is about not holding dollars. So how do you revamp that perspective, and how do you construct your portfolio with your underlying thesis? And these preferred instruments are one way to do that. You can still be direct. You can be harnessing the power of Bitcoin in when you perceive to be down times, which is fascinating.
It is. I thought the other thing that he highlighted, it would have almost been disappointing if he didn't at least address the broader market, right? So he started a big movement here. There's been lots of treasury companies that have come to market. They were certainly feeling the pain, and you heard him make the comment, and it was almost like a tough love comment, which was, this is what happens when you take on toxic debt. And what he's referring to is a lot of the convertible bond provisions or the different types of debt that these companies took on when, money was easier to get as long as you were willing to concede on a lot of different provisions. And he's highlighting the benefit of keeping your capital structure clean and effectively controlling your own execution from there. Being able to select the terms that you want to put on the balance sheet, not just what's available in the market. And, from the Treasury market perspective broadly, I think that's easier to say with hindsight right now, clearly. During the time when all those deals were getting done, there was a lot of excitement around it. It was one of those where you could pick a name and everything was running straight up. And so while money was available, I think all these companies were really trying to capitalize on that. But, it shows the power of long-term thinking, right? Not taking money necessarily because it's available today, taking money at the time when it's available at the terms that are going to benefit you over the next decade, not over the next 3 months. And, for a lot of the companies, I think they'll work through, the struggles that are going on right now. I also think that there was a shift in mentality, and you see this, right? When things are going up, everybody's willing to talk about the long term. And when things are going down, everyone wants you to do something drastic tomorrow, right? So, time frames from investors can shift on a dime, and it just depends on what they're seeing on the charts at any moment. And I think the message that he sent out there was you have to keep the long-term mindset. That's your job, right? If you're going to run one of these treasuries, you have to stay focused on what you're trying to accomplish 10 years from now. And you need to make the right decisions today to make sure that you're in the position to capitalize on the moments when it matters, to build that amplification, to put the right structure in place, to craft the products the correct way, and make sure that you're putting your company in a position to really be a leader in this space. And so I think that after you hear that and you hear their presentation and they go over all the benefits of digital credit, I think that a lot of the teams are going to be, back in their war rooms drafting out, what does the next 5 or 10 years look like for us? All right, we might have ourselves in a position now, but what we do have is, the best asset on earth. So, that's not a position of weakness. It's now you just need to look at your structure and be honest about where it stands and then figure out the right path forward. And I think that's what most will do. So I think you'll see a reemergence, but there's no doubt that capital just became harder, during this last cycle, and that's probably going to change the pace at which some of these can move.
They've got a very clear timeline to equitization of the convertible debt, which I think is very, very clear. By 2029, they expect to have a fully clean balance sheet. And I think Saylor said it. It's that I don't know exactly what he said, but it was something to the extent of we're going to have 30% Bitcoin yield with zero leverage. Yeah. It's like kind of coy, right? And there is no debt maturity. They don't have this cliff maturity on their balance sheet at a future point in time where you just have a dividend liability that you pay out into the future. And even when you're looking at the S&P 500, or not the S&P 500, the S&P rating methodology, the convertible debt weighed on the rating. And if you're able to remove that, then and you have the same amount of amplification on your balance sheet, that's an incredibly great story to tell to the market. You've got an improved credit quality and you're able to add more Bitcoin to your balance sheet at the same rate, potentially even a better rate. And then at that point, the common looks even more attractive as well because you don't have the risk of a debt maturity on the balance sheet. Everything starts to loosen up and lighten up with a cleaner balance sheet.
And you're also giving the market something they constantly have to be monitoring, right? Each one of those convertible bonds has a conversion price built in it. And so the market's constantly monitoring that to see, whether it's in a position where it could convert or if they're going to have to look to take another action in order to get out of that or roll it or whatever the case may be. And so, while strategy, they had the scale to really support convertible bonds. They could build out a really responsible maturity ladder. You saw them stacking them year after year after year. They would typically go out at least one full Bitcoin cycle so that they had a long time frame for the performance to happen within. But when you're a smaller company, you don't have that same luxury because you're likely not raising convertible bonds, 10 million, 10 million, 10 million, right? So you're going to have a bullet maturity out there in the future that the market has to look at, which is significant to your overall balance sheet. So while strategy, even with their converts, it's minimal to their overall amplification/leverage picture. But I did like that he did repeatedly say, and we have no leverage once these are gone, right? We'll have no leverage. We'll have amplification. We'll have no leverage. So he was definitely driving that point home that there's a different way to look at the convertible bonds versus the way you should look at the preferred equities.
The other thing that I really enjoyed was just how in depth they went on the return of capital dividends and the tax deferred nature of those things. I mean, this is something that, when they started selling these preferred equity instruments was not talked about and sounds like was not known. And I think we were already talking about why this structure makes so much sense for both the yield investor and the preferred equity, also the common and the amplification to the common. This shows like kind of something that while maybe locked into substantially increases the attractiveness of these offerings. I mean, the fact that you can do tax deferral for about 10 years of a very high dividend paying security. I mean, I still don't even think that the market truly appreciates it. I mean, you see a lot of people talking about it, but this should be something that should re-rate these higher. Like the price should go up, the yield should go down because these have tax deferred nature. And we actually haven't really seen that reaction yet, which tells me that it hasn't been appropriately priced in. But the difference here is massive. I mean, you look at the tax dividend rate, and they have it on the STRE slide of qualified dividends 20 to 35%, interest income 37 to 55%, return on capital 0. And this is something that is likely going to play out for many of the Bitcoin Treasury companies as something that they'd be able to achieve because of the nature of how they're done. But I thought it was nice how they went in depth on it, how they actually talked about the importance of that, the strategic importance of that for them to maintain that even if MNAV fell below 1, and how they might consider things like selling high basis Bitcoin, which I think is something that I don't think that they had addressed before this earnings call, that they would be willing to talk about that. And I think there were several of those different things that I think were stuff that they were unwilling to talk about, that they would consider buybacks strategically at some point. Not like they're planning on doing them, but they are open to these different things if it makes sense. I think shows further maturation of them as a story. But this return on capital, I think it's something that is going to continue to get airtime as something that makes these things from already super interesting, mispriced from a credit perspective to, I mean, frankly, like almost too good to be true when you put the tax deferred nature on them.
Well, think about it from the perspective of someone that's, retired and is living off of their portfolio. What he basically just told you is you have the ability to effectively double the returns of the S&P with a fixed income product, the average return. I mean, that's pretty significant when you look at it. Most retirees, when they start looking at scaling down, they start changing the composition of their portfolio. They start building out a fixed income component of it. They're planning to draw, 4 to 4.5% on the portfolio, and that leaves them with a certain blanket of safety. And now all of a sudden, you've got this fixed income security out there where the assets that could be used to pay those dividends into the future are already on the balance sheet. It's well over collateralized from that perspective. And now you're hearing that these are tax deferred. And, at the end, from an estate planning perspective, I believe you'd probably get a step up in basis if that passed down to your heirs. And so it's a massive home run from that perspective. And I think it'll take a while for people to really digest what that means, but that's game changing in a retirement portfolio, right? If you can get comfortable around underwriting the credit risk here on this, and understanding, what your margin of safety is given the strength of the balance sheet, those products in a portfolio make a material difference to the amount of runway you have based on what you've saved into retirement. So, while yes, there's a lot of institutional capital that's raised out of these products, and obviously institutions have enjoyed them very much, I think that these are critically important securities for people that are in retirement or coming near retirement to become aware of, just because they are so unique in nature. And all of a sudden, you've got this cash flow that you can depend on that's all return of capital that you're not getting hit with taxes on, which just greatly extends that runway, which I think would be relieving for a lot of people once you get comfortable with what these products are and what's backing them.
As fiat systems falter, wealth preservation isn't a strategy, it's survival. While the world reacts, Swan Private clients are already prepared. Swan Private builds strong relationships with clients around mutual conviction in Bitcoin's long-term promise. With concierge service, deep expertise, and airtight security, the Swan Private team helps build generational wealth the right way. Swan Private's comprehensive Bitcoin wealth platform serves over 5,000 clients with more than $4.5 billion of Bitcoin purchased to cold storage. Swan Private is built for long-term partnerships. Get started today at swan.com/private.
Matt, how common were ROC dividends in the institutional space back when you were working?
When I was at a pension, we intentionally would ignore them because we paid no taxes. And so when in an institutional space, I mean, when you talk about income securities that have either a tax-deferred or a tax-free nature to them, they trade at a higher price for the same level of risk if you strip that risk off. So for a fund that pays no taxes, like a pension, they become unattractive because they're attractive to people that pay taxes, right? Like that benefit is not attractive to CalPERS, but it's attractive to you and your individual account, right? And so there's a difference in the willingness to pay for that security amongst the different accounts. Now, with strategy in the prefs or other Bitcoin treasury companies like us in the prefs, I mean, I think the argument could be different because of the high yield nature of them, even without the ROC dividend. But in traditional space, like you wouldn't see a CalPERS have a large muni bond portfolio as an example, or something that would really care about the ROC dividend nature. But I think so it's not something that I was focused on in my past life.
Got it. Did you see many ROC dividends, or really you think about the tax efficient fixed income vehicles that are munis or other types of?
Well, think about as a corporate issuer, what has to be true to be paying a ROC dividend?
You have to not make money, no E&P, no earnings and profits.
And so most companies that would be issuers would not be eligible to pay a ROC dividend. Or with a Bitcoin treasury company, it actually becomes a strategic advantage that is massively helpful. And I think as it grows, will actually drive down the cost of capital. And so it's almost you're incentivized as a Bitcoin treasury company to be able to pay ROC dividends and not do something that would screw that up. I mean, you heard Strategy say that explicitly, that was one of their kind of KPIs, that they were going to try to preserve that their dividends would be ROC dividends regardless of market conditions. So it went something that you would typically say, do you want to be a company that would qualify for ROC dividends? Probably not. Now it's absolutely we do, and we're going to make sure that we qualify for these things.
Yeah, that is interesting thinking about the incentives of the operating company too, right? They've got 1,500 employees and they run the AI business, and at that point, there's now more incentive to invest like in R&D. If to the extent your company does have revenue coming in the door, you want to almost recycle that back into the business and grow the business to maintain the ROC dividend status to the extent that the market wants that.
Can you imagine the heads of people at the Financial Times right now when they hear this?
Actively managing for a successful outcome of break even. Yeah.
You're taking like the Amazon model and you're shoving it together with like Berkshire Hathaway, and then you throw Bitcoin in the middle of it, and Standard Oil too. So you've got like all of these companies, like the design coming together, and all of them creating just the most efficient vehicle of all time. It's a lot. The space is moving fast. I did like how they admitted that they've like fallen into these things too. they fell into it 6 weeks ago, or they were diving into this rock dividend status a bit more, and right, they fell into digital capital. Wow, this is amazing. This is pretty transformative. Now we've got a huge pile of digital capital. Let's look at the credit markets. Now you've got digital credit, and wow, this opportunity is big. We've raised $6 billion in 7 months. Like, let's keep pushing that. And then, oh wait, actually the dividends that are paid on top of these are actually even more attractive than we originally thought. So the credit spread or the yield looks even better than it originally did, and it's just a series of tailwinds that. I mean, the common equity may not show it, but the architecture of the tailwinds are there. Like the plumbing is there for a very productive future.
It's because they made a bunch of good decisions, though. They put themselves in a position to get lucky. It's just like, I mean, we've talked about this with Stripe. It's like, well, why are we in the position to be the first issuer, the pref only leverage? Because we turned down convertible notes. We knew that was a good decision at the time. We didn't know at the time that it was going to lead to this opportunity. And then it led to it. And then it was like, all right, guys, like, we're going to be laser focused on digital credit, on pref only leverage stack. That became clearly like the most important thing. And strategy did the same. They've made good decisions, and then that good decisions made them get lucky. You don't typically get lucky when you make bad decisions. So they've been patient, and then it just it gets better because the space moves so fast and it's so novel. It's impossible to look around every different corner like that. You just have to make sure that you're preserving optionality, doing everything you can to not encumber your Bitcoin, things that basically box you into a corner that you might be able to get out of, but is going to be painful and it's going to take time. You do that, and then that's when you're going to have these breakthrough moments. And I think the rock dividends are one of those that I think we're going to be talking about for probably the next several years.
Do you notice the one thing that's kind of just become an afterthought at this point already that none of us have mentioned yet? Just that they made $3.9 billion in operating income and $2.8 billion in net income, which means in the last 2 quarters, they've had $18 billion of operating income and about $13 billion of net income. Like, it just there's so much going on that you don't even focus on the highlight numbers and just how staggering that is.
Totally nutty.
But that's the buildup of years, right? And now you're starting to see that show up in the financials. Obviously, it took a lot of the accounting changes, but it's also the scale that they've achieved where, even minor movements in Bitcoin can have a really drastic impact. But, anytime that a company generates, $41 of earnings per share in 2 quarters, that's a pretty significant impact that's having. So
yeah, this is a $1.5 billion company 5 years ago, and now it's a $80 billion company. Was at one point like $100 billion company, and they're just getting started, right? Just tapping into new markets, just getting a credit rating. There's so much room to grow here, and I think it's something else that I think a lot of people are overlooking or not necessarily thinking about is that there's so many opportunities here for more issuers in the future. Like, we're at the beginning, we're at year one of digital credit. Like, okay, go think back to year one of insurance companies in the 1600s, or year one of banks, whenever banks started happening, right? There's opportunity to provide instruments to the market in different pools of capital in different places. And I think a lot of the criticism needs to be directed towards the other instruments that are in the capital markets that are poorly capitalized, poorly collateralized, bad business models, and underwritten poorly. And there's opportunity to clean up that portion of the capital markets with these instruments. So these Bitcoin Treasury companies, one message that comes to mind here is capital is going to go to where it's treated best. And when you have these issuers that are providing these securities that are paying a significantly higher yield, that is going to raise the cost of capital for the worst of the worst companies in the capital markets that traditionally maybe were getting debt capital 8, 10, 12%. They may not have the opportunities anymore to raise capital, and those are companies that maybe shouldn't exist. So it's an opportunity to clean up some of the bad business models, I think, within the capital markets. That could be viewed poorly, that could be viewed positively, but I think there's a significant amount of opportunity for multiple issuers in the space. I mean, not just us, not just strategy, and we're at the very beginning here.
They did also highlight the updates to corporate alternative minimum tax, which I thought was good, right? You forget all the different narratives that pop up along the way after they kind of get addressed once, but I think that those are things that need to continue to be highlighted. And they did, because they said without it, Bitcoin treasury companies would have faced billions in phantom taxes. And so having that guidance start to get more clarity, obviously there's a little further to go, but I think that's going to start taking away some of the concerns around these types of companies.
Yeah, Jeff, one thing that you said kind of married with or coupled with what Matt said, capital goes where it's treated really well or where it's treated the best. And then when Matt mentioned about potentially selling high basis Bitcoin, potentially buying back shares, I think this is super important because for basically 4.5 years, you had Saylor, who I think we would all agree is a Bitcoin maximalist, out there messaging, never sell your Bitcoin, we're Bitcoin maximalists. And now you're marrying that with nuance that you have both the Bitcoin maximalist side and you have the TradFi side of, hey, these guys they sound a little less crazy because they are, saying we will look at the market and see what we need to do and act appropriately. And it's all being very clearly communicated. And I think that's just huge for where we are right now in 2025.
Yeah, he did get asked the question about share buybacks. And, it's clear that that's not top of his mind here. Right? He's still pushing forward. He's still in accumulation mode. But to your point, what he did do was open up the discussion of nuance. And I'm sure that Saylor knows that amongst all the new companies that are coming to market, there's going to be different situations for each of them. And each company is going to have to do what's in their own best interest. But for him, he's got the weight of needing to be the example for what the rest of the market looks at as the foundation. So he may not be the one that's going to explore the edge cases, quite frankly, because he hasn't needed to, right? But you could look back and say, well, maybe you should have considered all those things back during 2021 and when they were really getting hammered and everyone was writing the articles about how he bet everything and he lost and the stock wasn't trading well, but what he did was he just kept his focus on the future and said, this is an asset I want to hold and I want to accumulate. And I see all the reasons in the world that this asset's going to continue to appreciate in price and I want to own a ton of it. And if that means that I'm going to have some of these lull periods where I have to wait, then I'm okay doing that. But he did, particularly when it came to the conversation around rock, keep open some of the options there because, that's a really valuable thing to hold on to. You don't want to, I don't think you want to dig in and lose that designation. I think that would probably be a mistake. And I'm sure that they know that because that's an immense value to the people that are collecting those dividends. So there's certainly a conversation for nuance, but I wouldn't say that he's necessarily changed his stance too much, right? I think he's still very steadfast and they're just going to be pushing forward and they're going to find ways to get amplification on, which is going to have to be a massive focus because they've got some delevering events coming over the next couple of years as well, right? You've got billions of dollars of convertible bonds that are going to be falling off the balance sheet and you've got to replace that with amplification through the pref model. So, these things are going to need to scale and they're going to need to be able to raise capital to be able to get that amplification up there so that they can continue to push that story down and show the benefit of holding the common equity here over a long period of time.
It was also refreshing hearing that they would consider derivatives, right? Bitcoin is capital, Bitcoin is collateral. There's optionality when you hold these things. I mean, that's something that can be considered to pay dividends in the future if that's the case. And that was the first time I think I've heard them mention that. So just emphasizing there's flexibility with these different instruments.
Yeah, he mentioned it once at Tim's conference. I think that was the first time that I heard it, was at the unconference. But I think it's an important message to get out there, going, listen, look at the pile of unencumbered capital that we hold here. There are steps you can take to utilize that. If there was a need to make it productive beyond having it as the credit backing for these instruments, we have ways where we could generate the cash to meet the dividends in the event that the markets, something adverse happened in the markets. You had a black swan event, for some reason they couldn't raise capital. There's other alternatives out there. And I think that's more the message that they're sending. They're saying there's lots of options. There's a lot of ways to pay these dividends. If you're only focusing on one of them, which is just the issuance of common equity, you're not seeing the whole picture. The picture is there might be a point where the common equity is below NAV. We've still got ways to pay those dividends. And I think that's a reassuring message to get out there, is to show that they know they have all these options. Doesn't mean it's their primary choice, but they know it's out there for them.
All right. Anything else? Final thoughts, closing thoughts before we wrap it? For the stream episode next week, the SEDA episode.
I'm good.
All right.
All I got.
Awesome. Well, thanks everyone for listening and watching, and we'll be back next week with another edition of The Hurdle Rate.